Hello, welcome. You're watching Inside India. I'm Sri Jegarajah. No let-up in the global market sell-off. From Tokyo to Singapore, the declines are significant and India isn't likely to be spared from the risk aversion, the rupee weakening sharply, and India holding out for a trade deal with the United States as the Reserve Bank of India, the country's central bank, meets today. A 25 basis point cut widely expected at this meeting, but could we see a bigger move? Asian markets are a sea of red. 1.5-year low for the Nikkei. Trading curbs triggered for the Kospi. Singapore, the silver lining here, off its lows, but we haven't seen these kind of moves in markets, in global markets for that matter, since the pandemic. And even the loss of trillions in market cap and likely economic pain doesn't seem to be dissuading or throwing President Trump off course and reconsidering these sweeping tariffs. The question now is stimulus, deeper rate cuts, whether it applies to China, India, and we will have that conversation later on in the programme, or the Fed. Of concern as well is even in the sell-off, even gold is being swept up in this risk aversion. So that really is saying something. US equity futures in the meantime are pricing an extended sell-off when Wall Street reopens tonight, following Wall Street's worst two-day decline since the pandemic that saw trillions of dollars wiped off the stock market. The Nasdaq in bear market territory, S&P 500 and the Dow not far behind, and the US dollar is looking like this. We are seeing some stability in the US dollar index, 103.13, but the payrolls picture seems to change things, seems to change the narrative somewhat, but the market broadly, FX market and the dollar, is pricing in this trashing, if you will, of the US exceptionalism narrative. And, of course, fears of recession. Stagflation is complicating the picture from the Fed and complicating, just really adding to this volatility. We are seeing inflows into the relative safe harbour of the Japanese yen, which explains why dollar-yen rate is at 146.57. Indian rupee, let's take a look at that, because the 1-month dollar rupee NDF market was indicating the currency sharply lower at 85.75, and that is where we stand roughly thereabouts. 85.78.70 is where dollar rupee stands at the moment. Remember that the RBI kicks off its two-day meeting today. The central bank widely expected to cut its benchmark repo rate again by 25 basis points, but there's question marks as to whether we could see a deeper cut and a front-loading maybe of rate cuts. There's also liquidity measures that have been something of a signature of the central bank governor Mohatra since he started and took over the tenure at the RBI in December. Right, let's put that aside for now. In comments just hours ago, President Trump saying he is not trying to engineer a market sell-off in response to questions if he was trying to force the Fed's hands to lower rates. This is what he had to say.
I don't want anything to go down, but sometimes you have to take medicine to fix something. And we have such a horrible, we have been treated so badly by other countries because we had stupid leadership that allowed this to happen.
So very clearly, President Trump isn't listening to Wall Street. The question is he going to listen to Main Street, and will the midterms be a big test of confidence on Main Street and the broader broader economy? Indian markets join us in about 45 minutes' time. Here's what Nifty futures are indicating, and broadly it looks like 22,500 could give way. 22,000 is the level in which the markets are pricing in terms of the downside. This picture could get a lot worse. Let's take a look at where we left off last week for the Nifty 50, 22,900. The soundings and the signals, of course, from the RBI this week are going to be of the utmost concern. Dollar rupee, let's remind ourselves where we stand there, 85.8110. So we are seeing some distinct weakness and selling pressure associated with the Indian rupee. Let's bring in our first guest of the programme. Balasubramaniam is with us, MD and CEO of Aditya Birla Sun Life joining me to talk about these markets. Bala, thank you for your time. How sharply do you think the index will gap lower today?
I think the way Indian markets have been behaving the last few weeks, and having seen a significant correction in the last year, where Indian market have been discounting some of the uncertainties well ahead of time, which has been reflecting behavior of FI outflows. My own feeling is today, though the index future may show a little weak openings in line with what you have seen in the Asian market, I think my own belief is Indian market may not correct significantly as we have seen in the global market. The reason could be one, as you mentioned, today's the policy meetings will start, and fundamentally, if you look at Indian inflation rates have been pretty decent. The oil price coming down globally would have a positive impact on India, and the trade impact that I think every country has been analyzing. India is, of course, is also somewhere affected, but not as much as what you have seen in the rest of the countries, rest of the world. Therefore, I think Indian market should behave more properly. Yes. The fall would not be as significant as we have seen in the rest of the Asian market. And yes, last but not the least, Indian retail investors have also been participating quite continuously. Therefore, the fall would also find enough support coming from the local buying.
Exactly. And relatively speaking, at 26%, India may have got off lightly compared to their manufacturing rivals in China, Vietnam and Thailand. So with that, Bala, do you feel that any drawdown, tariff-related or otherwise, is a buying opportunity for longer-term investors in the Indian markets?
I think definitely makes more sense from India point of view. One, the vision for India, which we call it the Viksit Bharat of 2047, to India to become a developed nation, that continues. Especially in the last 6 months, the Indian government has been stepping up their investment in various infrastructure projects. And we have seen a significant pickup in the private sector capex in terms of announcements, and the ongoing implementation also are progressing quite well. So therefore, India becoming fundamentally sound and strong when it comes to the question of taking the economy to the next level of growth momentum. At the same time, the last 1 year, correction, as I mentioned earlier, also brought the valuation of the market to a very reasonable level, about 19 times P multiples, yes, which from 24 times P multiples, which was there earlier. Therefore, any support from the earnings coming in from the Indian companies would naturally bring back the buying opportunity, bring back the performance of the company. Therefore, I would assume the current market conditions, and yes, India probably may turn out to be a good market to stay invested and increase exposure to India.
Understood. Bala, what are you expecting from the RBI, and how much pressure is there, given this global spasm we've seen in the markets today and last week? How much pressure is on the RBI to front load rate cuts?
More than the pressure from RBI, since the time the new RBI governor took charge about a month back, he has been focusing on not just only on inflation, he's also been focusing on growth, momentum should come back. And whatever the economic policy that monetary policy will consider, to support the Indian economy to get back on growth momentum, which essentially means pay attention to the falling inflation, pay attention to the slow growth that we are seeing in terms of credit offtake, and therefore ensure that one, liquidity improves in the system so that money remains cheap. And second is consider a 20 basis points rate cut, given the fact the inflation scenario has been extremely supportive, and overall growth momentum that we have seen in the last 2-3 years has also seen some kind of slowdown. Keeping these two things in mind, my own belief is RBI would cut the interest rate by 20 basis points, and then also provide some kind of extremely good amount of liquidity, yes, for the banking system to manage the current volatility that could potentially come and impact the liquidity system. Therefore, they will pay attention to currency, they will pay attention to liquidity, at the same time cut interest rate.
So 25 basis point cut for the benchmark repo rate, but do they need to, given the current environment externally, especially, Bala, do they need to signal a willingness to do more?
Of course, these are basically the moving policies. My own belief is having stated very clearly in the last two policies and even today's policy, they will probably keep it very, very simple and clear that the single most point that will be in the minds of RBI is to ensure that current volatility we manage the Indian volatility much better. Therefore, they will keep the room open for further cut, but I don't think they may probably say it in so many words. And given the fact that they need to pay attention as we move forward, the ongoing the monsoon impact which will come as we start hitting the month of May.
Yes.
The southern monsoon will begin, and the tariff cut, though we cannot ignore it, also need to be assessed in terms of what kind of potential impact it will have in India. At the same time, commodity prices coming down globally would definitely be positive for India, especially energy prices coming down would definitely be positive for India. Therefore, they probably need to keep their options open for incremental rate cut, but still 25 basis for rate cut this time coming in itself would reinforce the confidence of the market that yes, RBI is on right track.
Just getting back to the what you said, Bala, about Governor Malhotra. He's been easing liquidity conditions since he took over in December. Are more liquidity measures on the way?
Yes, I think this one single point factor is since the time the governor took charge, about 2 months, they already pumped in close to about 5 lakh crore of liquidity, which got pumped into the system through various tools that the RBI has got, including the OMO purchase and so on and so forth. I think they will continue to do so even going forward. And I think the liquidity will be made in such a manner, the surplus liquidity that is there in the banking system could be felt by way of the players, the banking players going and investing their money in the RBI repo rate. And that something would be probably be the ideal scenario in which Reserve Bank Committee will be working around it. But at the same time, Reserve Bank Committee has always provided liquidity whenever the market needs liquidity by way of security buy sell swap, as well as the currency buy sell swap. Therefore, as long as they have an open mind to provide liquidity, the system will not panic as far as the banking system concerns.
Bala, it's very stark picture here in Singapore today. When you look at the STI, when you look at the blue chips, the banks, they're all down very sharply. Where then does this leave the risk-reward proposition for the Indian banks, given the external balance of risks and given the liquidity measures that the RBI has taken?
Yeah, I think the Indian banking system is, of course, well positioned when it comes to the question of capital adequacy, in terms of focusing on the growth. On the way I think they have managed the asset liability management, I think is far superior. The NPL levels for Indian banking system is far better compared to the many years ahead that we have seen. Indian banking balance sheet is much stronger with low NPA provisioning that is required to be done. At the same time, what is most missing actually is the deposit growth versus credit growth. And now, of course, deposit growth has been higher than the credit growth. But as we move forward, as we start pushing on the credit growth, you'll probably see the credit growth actually exceeds the deposit growth as the Reserve Bank of India starts using some of the norms that they have set aside as the tight norms that they set aside last year. As they start relaxing it, I think Indian banking system should probably be the large beneficiary. My own belief is the large banks in India are well positioned to capture the growth momentum that could come the next, say, 1.5 years. Though they will probably go through some bit of volatility in the short term, but I think they are fundamentally very soundly positioned when compared to most of the global banks in the world.
How should we approach IT services and pharma if these are the sectors that have, for now at least, Bala, dodged the tariff bullet?
I think the pharma is one, in some sense it's getting impacted on this tariff, but given the fact, I think they have kept aside pharma outside the tariff list, and also given the fact the Indian pharma companies have been playing a very large role as a generic provider of product to the global manufacturing companies. Some of the internationally acclaimed companies have been outsourcing their API to Indian pharma companies. Therefore, they remain an integral part of the global medicine supply chain. Therefore, my own belief is Indian pharma companies should not get much impacted in the whole tariff momentum. Probably they could potentially be as we start seeing the progress, we'll probably see the pharma companies start performing better than what you have seen in the past. At the same time, service companies, I think India has got a large surplus in terms of software services. They have been the one who have got hit in the last few weeks, which was most surprising to all of us, given the fact that Indian IT companies, again, have been part of the large integral part of the global IT market. And therefore, it was very surprising But given the fact that Indian IT companies have got a very strong inroad in the development of the global IT space, and given also the fact that they have the huge balance sheet with the free cash flow running in, and valuations are becoming cheaper, I think there will be a
Yes.
time where the IT companies will become more value buy rather than a growth buy.
And again, at a sector level, how compelling are energy, consumer staples, utilities, and defence?
I think utilities and consumer space would become the longer space in India, given the fact the recent budget have given a lot of money in the hands of people to pay less tax and have more income in their hand, so that they'll be the driver of the next round of growth for India in terms of consumption going up. Therefore, consumer durable companies, I think, should largely benefit on account of this, as well as on account of increase in the per capita income of the rural Indian economy. That's something I see as a good change. I think utility is something, I think India has created self-sufficient energy sectors, given the fact that India has been progressing quite well, both on increasing the capacity on the thermal power as well as renewable power, and ensuring that Indian consumers get 24/7 power supply at home, as well as for the commercial purposes. At the same time, oil price coming down globally would also be the large beneficiary would be India. Therefore, energy sector should also get the benefit of
Yes.
the change in the current trend, as well as fundamentally they are becoming stronger in terms of generating more cash in the books of in their business.
Bala, just to wrap things up, in terms of where we stand, where are you putting the Nifty 50 or end year target? How vulnerable is it looking, given the current global setup and given the current stress and the growth concerns? And how much of a defensive posture do we need to build into portfolios? And how strong is the case for holding more gold in your portfolio?
Sure. I think it is one thing that we have been watching as far as the Indian Nifty concerned. Nifty is about 22,600 or something, somewhere close to that. And often it has tried to actually go below 22,000 index, but it never happened, given the fact that at every point of time when the price falls, it becomes fundamentally sound from a valuation point of view. My own gut feeling is it can potentially correct by another 3 or 4%, worst case scenario about 5%, which essentially means should find enough support at 20,000 index, if at all that level comes to. But otherwise, you should find support around 20,000 index for a considerable period of time. And the gold is something has been the India has been the large beneficiary of gold price rising. And as we know that Indian household savings in gold is even far higher than the probably I would assume close to the GDP numbers. The numbers of course not known, but given the fact that India traditionally has been the large owner of gold at the household level, this rise in gold would probably the bigger beneficiary would go to actually Indian households in the country, which essentially means that they will be able to actually withstand any kind of pressure that could come and hit the economy, if at all that happens.
Bala, it's been a pleasure speaking to you. Thank you very much indeed for your thoughts on this debut edition of Inside India. Bala Subramanian there of Aditya Birla Sun Life AMC. Right, India's finance ministry also commenting on the tariffs just a while ago. Let's get out to CNBC TV18's Mangalam Malu for more. Mangalam, great to have you on the programme. Are we looking at Black Monday for the Indian stock markets today, or is the RBI going to ride to the market's rescue?
Well, there are a couple of truisms in the market. It says that, when everything goes down, the only thing that goes up is correlation. And that's exactly what is taking place. The Asian indices are witnessing a very big cut, almost 6 to 8%, whichever index that you look at. But the Indian markets are relatively stable. So when you speak about Black Monday, chances are that India will see dark brown Monday as against a Black Monday. The GIFT Nifty indicating a cut of almost 3.5% from the peak. And the bigger reason for that is that India seems to be relatively limited to its exposure when it comes to fundamental exports. Exports over the last 10 years, I've been looking at the data, are sub 25% of India's GDP. In that itself, the US exports account for sub 3% 8% of India's total GDP. In that as well, nearly 30 to 40% comes in from service. So that limits India's exposure. The bigger exposure, however, is to global markets and the weakness out there. So that's something we'll most definitely need to keep an eye out on. The Nifty itself has corrected by about 12.5%, 15% from its highs. Mid and small caps have even more. There is some improvement in the domestic environment, and I was reading a report that came in from you itself, which said that the Indian government has said close to 6.3 to 6.8% growth targets for the next couple of years could be maintained if oil prices stay stable around that $70 per barrel mark. And that's pretty much the case that we've seen. And large imports that India makes is in the form of oil itself, and that has been close to $64, so that's a mild positive for us. But the global sentiment is that of fair amount of uncertainty, a serious amount of fear, and that will reflect in the Indian markets, not as much as to the other Asian indices or other Asian markets, but we won't be spared when it comes to the fall. The only thing that we'll be looking at, apart from the RBI or the government institutions supporting the market today, would be flows going out of China. Will they find their way to India or not is the big question, because if India is the cleanest shirt in the global laundry, then could flows find their way into India or not is the big question we'll be tracking, not just today, but over the next couple of months.
It's all about relative resilience, isn't it, Mangalam? Thank you very much indeed for that. But today, for at least in line with this global risk aversion, 22,000 on Nifty 50 does look vulnerable. Mangalam, thank you for that, sir. You can follow our CNBC live blog for all the market developments and updates you need throughout this market turmoil. And still to come on the programme, we'll hear from Neelkant Mishra, member of the Indian Prime Minister's Economic Advisory Council and Axis's bank chief economist. Will India be able to strike a trade deal with the United States and lower tariffs? Plus, HSBC's chief India economist weighs in on the country's place in this new world. You don't want to miss those conversations. Keep it here. You're watching Inside India.
Like that. That's no problem.
Come to me.
No. What are you doing? Josh! Dude, where did you go?
You have got to see this.
What are those claw marks?
One of 5 immersive worlds in Epic Universe, only at Universal Orlando Resort.
Kelly Evans with in-depth reporting of the day's most compelling stories, economic analysis, market updates, and where to find opportunities now. Strengthen your investment strategy on the exchange. CNBC.
Tiny homes.
Welcome to my tiny house in Atlanta, Georgia.
One woman makes big money with a very little house.
Pretty spacious, honestly.
Plus the Big Apple's version of living little.
My 95 square foot New York City apartment.
And downsizing to unlock a better life by the beach.
No regrets about moving into a tiny house. There's no room for excess or unnecessary objects.
That's all next on Unlocked.
Are you drowning in debt? Stressed over savings? CNBC Make It is here to help. Start your journey to financial wellness today with our new online course. Our experts will teach you about money psychology, saving for retirement, and increasing your investing IQ.
Achieving financial wellness is freeing, it's empowering.
Your healthy relationship with money starts here. Register right now at cnbcmakeit.com/financial wellness.
Ambition is a recognition that you only have one life. To work to maximize your time here, it is about growing, learning, and also challenging myself, not being afraid to make mistakes.
Welcome back to Inside India. Here's your news update at this hour. US President Donald Trump says he'll discuss trade with Israeli Prime Minister Benjamin Netanyahu. The US had imposed tariffs of 17% on Israel, despite the country saying it would scrap all duties on American imports. European Union will likely issue its first response to the US tariffs today. Coordinated response covering up to $28 billion in US imports from American meat and wine and even gum and toilet paper. And tens of thousands across the United States marching in a nationwide, quote, hands-off movement against Donald Trump and billionaire Elon Musk. This weekend's demonstrations were the largest single day of protests against Trump since his return to the White House. Let me bring you up to speed with the response at a government level to these tariffs, and let's key in on Australia and the Australian Treasurer making some comments about this. Expect Australian GDP to take a hit. We expect big hits to US and Chinese growth. The direct impact of tariffs, however, on the Australian economy will be manageable. And again, you see this reaction function putting the ball in the court of fiscal and monetary policy to possibly step up now. So the Australian Treasury and the Reserve Bank of Australia appear to be discussing, communicating and coordinating. Treasurer Chalmers spoke to RBA Governor Bullock to compare notes on expectations. And Treasurer Chalmers says the fall in the Australian dollar is largely as a result of concerns about the Chinese economy. Australian markets looking like this and not being spared the APAC sell-off, let alone the global sell-off. S&P ASX 200 down by nearly 4%. We got the Australian dollar weaker against its US counterpart by about 0.3%. So shifting the focus on the RBA and fiscal policy as well. Heavy selling in the Southeast Asian markets too. Singapore among the worst hit, especially the banks. JP Yong joins us with an update now. Good morning. Good morning. Yes, it is still morning. Yeah. Thank you.
There's been so much that's happened so far this morning, Sri, that I don't blame you for having your times crossed out. But, you know, it is one of those sell-offs that's leaving a lot of people in the markets dizzy and reeling at the moment. Among them, the Straits Times Index falling also in today's session. And they are actually testing correction territory, which means they're about 10% below those 12-month highs. And again, a lot of this down on how the banks are faring, because the likes of DBS, UOB and OCBC combined is about 50% of the STI's entire weighting. And you take a look at how DBS is faring in today's session, down by about 9.3%. At one point, that sell-off was about 13% down at the open. So they've pared some of that back. But nevertheless, when these three are in decline, it will pull on the Straits Times Index. Take a look at Yangzijiang Shipbuilding. They're a Chinese shipbuilder listed in Singapore that's also down by about 10.6% today's session, also contributing to the downturn. Now, it's also important to note that Indonesia, Vietnam, and Thailand are offline in for today's session, but all three come online tomorrow, actually, and there could be a bit of a reckoning for these three markets, especially with Indonesia about 150 points away from testing bear market territory, and Thailand in bear market territory since the start of March, actually. So again, a lot of these markets also getting hit hard. Vietnam facing also the highest tariffs in Southeast Asia, or among the highest tariffs in Southeast Asia, and the Vietnamese could also see a downturn when they resume trading on Tuesday, Sri.
Yes, expect some pent-up selling pressure, and a lot of it for the Indonesian market. Coming up, HSBC's chief India economist joins us next to talk about the tariff impact on India's economy.
On a $100,000 US margin loan, Interactive Brokers charges just 5.83%. Do you know how much your broker charges? Fidelity and Schwab charge over 1.5 times as much. E-Trade is even higher. Move your account to Interactive Brokers and save at least $5,200, or much more if you're trading big bucks.
Sink this ball into that hole. Sounds easy, but it takes patience and practice to gain an advantage when so many factors affect my game. It's a lot like investing, but with CNBC Pro, I'm never playing the markets. I've got an advantage. Pro's exclusive investor toolkit, plus CNBC's team of global market experts. So for even the most challenging shots, I have the strategy and tools I need to reach my goals. Seize your market advantage with CNBC Pro.
We're moving from the autopilot era of AI to co-pilot era of AI.
We are just at the dawn of the robotics age.
The more experience you give it, the more capability this AI model can achieve.
Hopefully improves productivity, and it doesn't displace more jobs than it creates.
How to maintain our humanity if we live more and more digital lives.
The new era of tech on CNBC.
I took my first journalism class in high school. It felt like a superpower.
I find it really meaningful to reach new audiences, women, people of color, younger demographics. A lot of traditional financial advice might not take into consideration that people have debt or that rent is so expensive. To me, ambition means taking on new opportunities that take you out of your comfort zone, but help you learn and grow.
Welcome back. Japan's markets resuming trade after a much-needed lunch break. It's been an ugly session with the Nikkei in bear market territory. Lin joins us with more 1.5-year lows for the Nikkei.
Yeah, indeed. And Sri, we really saw the intensity of that selling pressure, particularly at the get-go, with the futures trading both for the Nikkei 225 and for the top picks. That was activated as well. And we did see that the benchmark Nikkei 225 was down by close to 9%. And as we return for that afternoon session, 6.7% lower, keeping in mind a 9% downside as well last week. And this is, of course, on these concerns around the escalating trade war, the reciprocal tariff that was, of course, applied on Japan as well, and the fact that it doesn't appear that there is any kind of reprieve in sight. Add on top of that, the appreciating yen, JPY is a safe haven bid, although some of that bid throughout the day has come off a bit. 146.40 is where we're at in terms of the afternoon session. We're seeing a big sell-off continuing, whether that's in terms of some of those commodities exposed stocks on these recession fears. Also tech and certainly as well financials, banking stocks 20% lower last week, underwater significantly by close to double digits again. And you know, we're seeing that as well when you look at the fixed income space, those JGB yields continuing their steep decline as well, if we can get up some of the yield picture there. But as far as the policy response is concerned, we've been hearing all day from the Japanese Prime Minister Shigeru Ishiba basically noting a couple of things. The first, he says, is that they are looking to put forward to the US president a comprehensive package of measures here, but he warned this isn't going to happen overnight, that this is going to take time. And in the meantime, Sri, he is looking to put forward a package of measures to help companies, beleaguered companies dealing with these tariffs ahead.
Yes, and that's what the conversation is about now. Deeper rate cuts, deeper economy-wide stimulus measures, and the Nikkei trying to get off these session lows, but having a tough time. Thank you very much indeed for that, Lynn. We are counting down to the market open in India. GIFT Nifty futures tipping a 3.5% drop, so we're talking about a near 1,000 point drawdown for the Nifty 50 at the open at 11:45. Let's switch gears to the RBI and get out to CNBC TV18's Latha Venkatesh for more on that. Latha, great to have you on this debut edition of Inside India. And 25 basis point cut has been more or less priced in, but could the leadership at the RBI signal a willingness to do more?
There is a very good possibility that they want to show more dovishness than just that 25 basis point cut. The expectation is that they could change the stance. The stance now stands at neutral, and they could change it to accommodative. I wouldn't say it's a majority view or a consensus view in the market, but it could be getting there with the markets losing more and the global economy now quite clearly indicating recessionary trends, at least in some parts of the global economy. So that could happen. What other signs of dovishness that we could expect from the Reserve Bank is if they brought down the GDP number. In the February policy, they had forecast the FY26 GDP at 6.7%. That certainly is not a number they will stick with because of the global slowdown that's staring us in the face. Our own impact from the US tariffs would be less because India's total exports as to the US as a percentage of GDP is only 2%, and perhaps a little bit can be negotiated lower. But we are exposed to the global economy. So 6.7 won't stand. Something like 6.5 or lower is possible from the Reserve Bank. That would be a sign of dovishness. Inflation forecast for FY26 is 4.2. The expectation is that if goods don't sell to the US, people would be dumping, especially China could be dumping it on other countries. So a lower than 4.2% forecast of FY26 could also be possible. So all that would be signs of dovishness.
Like that, even heading into this global trade shock, the Nifty Nifty 50 lost more than $1 trillion in market cap. So the backdrop is quite fragile, and I'm just wondering, do you fear that there is going to be more liquidity withdrawn from the market drying up as consumers, businesses and companies become more gun-shy, less optimistic about the future? And where is the RBI in terms of addressing a possible liquidity crunch?
Well, actually, the RBI has been pouring liquidity into the market simply because it intervened a lot in terms of supplying dollars, and that pulled off rupee liquidity. So they have been supplying tons of liquidity. In the first quarter, Jan, Feb, March, they supplied 7 trillion rupees of liquidity, and they've announced another bond purchase in April of about 800 billion rupees. So they are in a liquidity pouring mode, which is why people are expecting a stance change, to accommodative, because you are being accommodative practically. They will continue with that. It's unlikely they will announce anything on liquidity on April 9th itself, because it's an ongoing thing. They may simply reassure their commitment to keeping a liquidity surplus in the interbank system. As far as the fall in the markets is concerned, that clearly has an impact on wealth effect. So far in India, it wasn't such a large number of shareholders that a fall in the markets creates a wealth effect reduction. But now there is clearly a large number of people whose wealth is attached to the stock market. So yes, that will have an impact on the RBI's thinking. But my sense is they may not go to a 50 basis cut. They will stick with 25.
Lata, I'm very grateful for you joining us and your insights today. We appreciate it. I hope to be speaking to you and working with you in the future much more closely. Thank you, Lata. Right, let's bring in Pranjal Bandari now, Chief India Economist at HSBC. Pranjal, thank you very much indeed for joining me on this debut Inside India programme. Do you fear that 6.7% headline GDP for India is now at risk, given what we have learned from this global tariff shock?
Yes, I think so. What's happening here is that the impact of tariffs on India can both be direct and indirect. The direct is, in terms of the exports exposure India has to the US, and there the 26% tariffs can actually shave off 0.5 percentage points from GDP growth. So if you had a GDP growth estimate of 6.5% going into the whole tariff situation, it could come down to about 6%. And that's just the direct impact. There's also a pretty meaningful indirect impact that can happen if global export volumes, global FDI flows actually slow. And then if you see a lot of rerouting of exports, for example, say exports from China coming into India in a bigger way than before, and that hurting India's manufacturing. So that indirect impact could also aggravate the situation. So one way or the other, direct or indirect, our sense is that growth will need help going, in the next couple of quarters.
Pranjal, on this issue of the RBI possibly front-loading rate cuts, could they go by 50 this week?
Look, we're sticking to 25 basis points for the simple reason that if you go with 50, you signal panic. And I think that's one thing the RBI would not want to do. I think, if anything, they would want to show that everything is extremely calm. By the way, even the dollar rupee has been extremely calm. And I think they'll want to show everything is extremely calm. But having said that, my sense is that we are going to get back-to-back rate cuts. So in April, then in June, and then in August. So by end of August, rates could be about 75 basis points lower than where they are today. And my sense is that even after that, although I don't have them in my forecast, the risk, if anything, is for further cuts down the line, even beyond August.
How would you rate Governor Malhotra's job of keeping liquidity flowing through the broader Indian economy and the financial system, Pranjal? Are there more liquidity measures that are on the way?
That's a great point. I think alongside rate cuts, I think the new governor has also taken his job of providing liquidity extremely seriously. From January onwards, he's been giving you liquidity from every possible door, like OMO purchases, FX swaps, VRR of varying tenor from 1 day to 51 day. And, I would argue that he's infused liquidity of close to 7 trillion just in a matter of 3 months. I think going ahead, what the market wants from him is that, yes, you've given this liquidity, but now we want assurance that this liquidity will stay in the surplus zone for the prolonged period. Because what we saw in the last couple of years was liquidity was very volatile. It would become surplus and then shoot back into deficit and then become surplus again. And now what markets want from him is surety of surplus liquidity for a long period of time. And I do think that even if it's not in the upcoming meeting on Wednesday, my sense is that in the next couple of months, they will be relooking at their liquidity framework to design it in such a way that liquidity remains in surplus for a prolonged period rather than in a very ad hoc manner. So I think there's a lot more to hear from liquidity. We may not hear everything on Wednesday, but beyond that as well.
Pranjal, and if Prime Minister Modi successfully pulls off a bilateral trade agreement with President Trump and the United States, is that a game changer for India's economy and FDI inflows, or is it only really going to help at the margins? And ultimately, where do you feel all of this puts Indian bond yields and the rupee?
Right. Great question again. Look, a lot of people in India onshore are getting excited. They're saying that, look, India's got 26% reciprocal tariff. Some others have got a lot more. So maybe this is an opportunity for India. I think that's too hasty, a comment to make, because even if it's a 26% reciprocal tariff, there are just so many moving parts. We don't know what negotiations are going to happen with India or with other countries, in the run up to 9th April or beyond. So I think it's sort of premature to get very excited about that right now. But what I am getting excited about is the fact that for the first time, I'm finding India being a little more proactive and trying to sign off some of the trade agreements with the US, with EU, with a little more urgency than I've seen in the past. And I think this will help if India can do literally 4 things: fast-track trade agreements, continue to cut many of its own tariff and non-tariff barriers, allow the rupee to be flexible in a way that it has already been doing, and be a little more open to FDI from the region, particularly FDI from China. I think maybe not immediately, but over the medium term, India could be a beneficiary, because at the end of the day, we are seeing a lot of the supply chains getting rejigged, and a lot of that may continue over the next year or two. And for the first time, I see India showing signals that it's open for business. And I think if that continues, then India could attract a lot more of the regional FDI and start producing things and exporting them. But for this to happen, India will have to persevere on reforms sort of path.
Realignment, and there's even a fascinating conversation about Chindia rising now, and the dragon and the elephant dancing. Pranjal, maybe that's another conversation for another time. Thank you very much indeed for joining me on this debut of Inside India. Pranjal Bhandari there, HSBC. For more insights and updates, subscribe to our weekly newsletter, Inside India, to stay updated with the latest market-moving trends and news shaping the economy and businesses leading the rise of the country. You can scan the QR code on your screens to become a subscriber. Let's shift focus now to the Middle East. And Dan Murphy is joining us from Abu Dhabi. And Dan, lower oil prices, good news for the Indian economy, but it's a problem, isn't it, for the GCC, especially when it comes to trying to finance these massive reforms they are undertaking?
Absolutely, Sri. So no doubt this is a major focus for us this morning on Access Middle East. We're going to cut through the noise of this market sell-off. You've been doing a terrific job bringing us insights and analysis on Inside India. That's going to continue in the next hour. I'm going to be speaking with BlackRock's Ben Powell. He's joining me to break down what happens next here for markets. We'll unpack all of the carnage and also get a preview as we track into what could be a history-making session on Wall Street. I'm going to ask him if this is market panic or if it's a rational repricing of policy risk, and of course how to trade it as well. And Sri, as you mentioned, with oil prices tumbling right here, right now as well, we're going to hear from energy expert and former diplomat David Goldman on what's driving the sell-off. Of course, Goldman just cut its own price forecast for Brent and WTI, so we'll talk about how far prices might need to fall before OPEC steps in and where the bottom might be. Back over to you, Sri.
Excellent. I'm really looking forward to the new programme and great to see you. Coming up next, we'll hear from a member of the Indian Prime Minister's Economic Advisory Council. That's Nilkant Mishra joins us. Will India get the US trade deal it's looking for? We'll find out after the break.
I do think it's important to have a day like International Women's Day. They always say that the last 5% is the hardest part of a project. So I think that the last 20% of moving women's rights forward globally is proving to be harder than we thought it might be. If you want to create truly inclusive campaigns, you have to make sure that the people that are being included are represented in an authentic way and are consulted at every step of the way. So you need to make sure that it's not just in casting. You know, the scripts are looked at and, you know, there are kind of low-level nuances that community know. So yeah, nothing about us without us.
You're French, the son of two physicians, grew up in a family where you're focused on medicine and life sciences. How would you describe your leadership and your management style?
I'm very collaborative. I don't like consensus, which was something we changed.
You don't
in
like
the company.
consensus?
No, because I think that consensus is slow first, but also sometimes impossible to reach when you have a tough decision to make. So often everybody agrees, but if there is no consensus, it's not a reason for not making a decision. So very collaborative. I try to have a lot of proximity with people. I am very approachable. I want to be very inclusive. I empower a lot the Takeda executive team. So again, I think creating a culture of performance, but respect and inclusion and collaborative.
Welcome back. Let's take a look at the Indian markets, which have just joined the trading day. Global rout, global risk aversion, and India doesn't seem to be spared, in line with what Gift Nifty futures were telling us. We're looking at a near 4% drop, and that selling momentum does appear to be gathering steam. We've got the Indian rupee under some pressure. Not considerable pressure, but still pressure nonetheless against the US dollar at 85.65, and Nifty breaking below 22,000. Again, it's not gapping lower below 22,000, but nonetheless, this still constitutes a near 1,000 point drop for the Nifty 50. Zooming in on the sectors, let's give you the sector breakdown here. We are looking at the banks. Heavy losses there. Pharma is somewhat counterintuitive because they were spared the tariff dragnet, but still down by more than 3.5%. FMCG doing badly as well, down by more than 3%. And autos really the worst off the bunch here at the sharp end, down by 5.3%. US imposing 26% tariffs on India, but a government official telling Reuters that India does not plan to retaliate against the US tariffs, citing ongoing talks for a potential trade deal. New Delhi sees a first mover advantage in being one of the first nations to have started talks with the United States and feels it is better placed than others, Asian peers, that have been hit by higher tariffs. Let's stress test this now with Nilkant Mishra, Chief Economist at Axis Bank. He's also a part-time member of the Economic Advisory Council to the Prime Minister of India. Nilkant, thank you very much indeed for joining us. Can you tell us your thoughts about the BTA, about the bilateral trade agreement. How successful do you think it will be? And will it be a game changer for the Indian FDI story and inflows, or is it only really going to help at the margins?
No, I think it's a very important deal to start to sign. Given the scale of the disruption, it makes sense for the US as well to focus on accelerating the trade negotiations with countries like India and Vietnam, where frankly there is not that much of an impact on the strategic autonomy that it seeks to have. For many of the sectors in India, there is quite a bit that is complementary to the US. And frankly, it's in India's interest to get access to some of the very attractive markets, like in apparel and footwear, where India has a lot of cheap labor. And because of the higher, because we didn't have a trade agreement versus, say, a Vietnam, which had one,
Yes.
there was a structural disadvantage. So there are many, I think, complementarities. And such a deal would be very beneficial to India.
Neil Kant, relatively speaking, at 26%, and it's all relative, isn't it? India may have gotten off lightly compared to its manufacturing rivals in China, Vietnam and Thailand. How much of a relative competitive advantage does this yield for India?
See, we should not, and in fact, no one in the government would be assuming this, neither would anyone in the industry assuming that these are the final rates. Very quickly after the Rose Garden speech, Scott Bessent very clearly stated that please do not retaliate. This is just the starting point of a negotiation. And so the negotiated rates are likely to be much lower. Frankly, it's very hard for me to believe that the US believes it has the labor strength to start manufacturing shoes and apparel, or that its pharmaceutical industry really wants to go back to manufacturing generics. So when it comes to these negotiations and assessing the impact, while at this stage you're absolutely right, this is an advantage. We are at the margin seeing that buyers from the US are now, for example, in apparel, are now scouting out for supplies from India. But say 6 months or 9 months later, when all of these, at least some of these deals have been settled, that advantage may not be that meaningful.
Neil Kant, do you feel that the Indian government could yet retaliate against 26% import tariffs, possibly even higher?
I think the government has very publicly stated that there is no intention to retaliate, and that, in fact, they were first off the blocks in negotiating the bilateral trade agreement. From what I see in the press, there is significant movement, positive movement on that. There have been visits by the USTR to India. The Indian Commerce Minister has visited the US several times. So I think such a deal, India should be confident, and perhaps is, that they will be able to negotiate a very successful deal with the US.
Do you feel 6.7% headline GDP is at risk?
I think it is. And the India is the least among the major economies, the least exposed to the US export business on the goods side. So only about 2% of GDP. In fact, our estimate is that the tariffs by themselves add about $10 billion, of which, in our view, 60% will be passed on to the US consumer. So the net impact is only about $4 billion, which is 1.1% of GDP. So it's actually very small. What I worry about is the second order effects. So what you're seeing now is a very sharp increase in equity risk premia as uncertainty picks up. We're also seeing significant disruptions in trade. For example, you can exempt semiconductors, but if the servers which are being shipped to the US are still going to attract duties, upstream, you will see a supply chain bullwhip coming through, which can be very, very meaningful. So those effects, or say if the banking sector in the US slows down and sees significant stress, a lot of the outsourcing to Indian IT companies and the BPOs and the global capability centers can start to slow down. So there can be significant second order effects which could be
Yes.
upwards of 50, maybe even 100 basis points of GDP.
Neil Kant, and to that point, yes, IT services were exempt, but the Nifty IT index, when you look at the price action in today's market, extending losses, last down at 7.4%. What then should we expect, Neil Kant, from the RBI this week? And do they need to signal a willingness to do more in terms of rate reductions?
So it is now consensus that the MPC will cut by a further 25 basis points, taking the repo rate to 6%. There is a lot that they have done already. Frankly, one of the major reasons that the economy slowed down over the past year was the RBI's excessively tight liquidity stance. In the last 3 months, the RBI has done a lot of work to bring liquidity back to normal. We are starting to see effective rates come down substantially. That should be very helpful in supporting credit growth in the economy and therefore supporting the GDP. But the big question mark will be whether they change their stance. There are some people who expect that the MPC would be changing their stance from neutral to accommodative. Frankly, given the level of uncertainty that exists in the world at this stage, I would expect the MPC to retain its flexibility and retain the stance at neutral, so that in case need be, see, for example, the first response to the tariffs was a weakening of the dollar, but as the uncertainty is now spreading all over the world, the DXY is starting to bounce back. And so, if, for example, if you start coming under currency pressure, you may need to raise rates. So I think the MPC will retain that flexibility. A lot of the good work has already been done through the liquidity channel, and therefore, I think the banking system now has the ammunition to go out and grow credit again.
Neil Kant, on that note, we'll leave it there, sir. Thank you very much indeed for joining us on this debut edition of Inside India with your insights at this critical time for the Indian markets and the macro. Neil Kant Mishra there from Axis Bank. On that note, that's all the time we have today on Inside India. Do keep watching the network and CNBC Access Middle East, a new programme with a good friend of mine, Dan Murphy, coming up next.
Sponsored by Energy Asia, by Petronas.
Highlights from CNBC's Sustainable Future panel, Innovating Through Change.
There is an opportunity in every crisis, and perhaps this is an opportunity, and this is not new. I mean, Trump was there in 2016, and the transition continued at a certain pace.
In the first Trump administration, there was a coalition called We're Still In, and we saw a lot of leadership from the corporate sector during that time.
We have to subsidize this climate change. Gas is an extremely important part. I also believe that we need to make sure we have several options, including CCS. Let the capitalist system pick the best.
The energy transition we're talking about is one of the most expensive transition the world will ever do. It's physical assets that you are changing. You got 8 billion people that are changing habits.
Sponsored by Energy Asia, by Petronas.
Tiny homes.
Welcome to my tiny house in Atlanta, Georgia.
One woman makes big money with a very little house.
Pretty spacious, honestly.
Plus the Big Apple's version of living little.
My 95 square foot New York City apartment.
And downsizing to unlock a better life by the beach.
No regrets about moving into a tiny house. There's no room for excess or unnecessary objects.
That's all next on Unlocked.
Find your hustle. CNBC Make It's new online course, How to Start a Side Hustle. 3 industry experts break down proven paths to success and help you choose the one that fits your life. Go to cnbcmakeit.com/side hustle to register now.
You want people to trust their money.